when you have a certain target in the chart. So for example, like we see that is the target. On the way to reaching that, we might reach a swing high right there. That is liquidity. In order for us to reach the target, we should actually see a run on liquidity. Whereas if you see a sweep of liquidity, we actually get a reversal. So understanding the difference between a run and a sweep of liquidity is crucial. And that's exactly what you're going to learn in this video. We are going to dive into, first of all, what is liquidity, and after, why is it relevant, and afterwards, how we use it. Welcome to episode number 3 of Pips to Payouts. Now, first of all, what actually is liquidity? When we see this price action right here, we already have one form of liquidity, and that is that swing high right there. Swing highs are liquidity. Now, next to that, we also have this candle, that previous candle low right there is actually also liquidity, because that is what we can, for example, sweep right there to then continue higher. Now, after that, we also see that we create a swing low. So a swing low right there is also liquidity. Then we see in the most recent candle, we also have a previous candle high, and that in itself is also liquidity. So to sum that up, swing points, which consist of swing highs and swing lows, that is liquidity, but also previous candle highs and previous candle lows is also liquidity. Now they are relevant in their own perspective, because previous candle highs and previous candle lows are mainly relevant when we talk about 2 candle rejection and also the 3rd candle of fair value gaps, which is something we're going to dive into. So for this example right here, we see the previous candle high right there gets swept. So that allows us to understand what type of fair value gap we are dealing with. If we are running that previous candle high, we might be dealing with a breakaway gap. But if we're sweeping it, we might be dealing with a consolidation or a rejection fair value gap, depending on how large the rejection or the sweep is. But the same way, when we take and scroll a little bit back, that previous candle low is part of the 2 candle rejection right there, which is also something we're going to dive into later on in this video. Now, the reason why those previous candle highs, previous candle lows are also liquidity is because what you usually see on one time frame, they are previous candle high, previous candle low, but on the time frame below it, it usually turns into a swing point, so a swing high or swing low. And that's important, because those swing highs and those swing lows, so those swing points, that is what we're going to focus on mainly throughout this video, because that tells us what the next target is likely going to be. So knowing what the next target is, and also if we then see a continuation or a reversal. So what happens quite often is when people don't understand the difference between a run or a sweep of liquidity, they might get blindsided by it. So for example, right here, where you think price might still want to continue lower, all of a sudden we sweep this low towards the left, creating a reversal instead right there. So if you, for example, try to trade this to continue lower, well, then that's an unnecessary loss. Now, why is this relevant, this liquidity? And for the reasons we just mentioned, yes, but also understanding that the market runs on liquidity. So what I mean by that is not the run on liquidity we're going to talk about as well, but actually that it operates on liquidity, the market. So it needs to have liquidity to make certain moves actually happen. Now, what I also need you to understand, and this is quite important, when we talk about liquidity, I talk about large hedge funds, large institutions that actually have millions of capital, probably even billions sometimes, inject that capital into the market. I'm not talking about me, your average Joe that is trading with a few lot sizes or even a few minis when we're talking about futures. So neither yours nor mine liquidity is relevant. Now, unless you have a large hedge fund, then I'll take that back, but I don't think that's the case. So for example, you'll see this sometimes on social media that the market makers are hunting my liquidity. Now, again, you have to be a little bit delusional, a little bit egoistical to actually think that that is true. Because most likely, unless you're trading very relevant liquidity, large amounts of liquidity and capital, it's not going to be relevant. But like we mentioned, the reason why this is relevant is because this is happening. Some liquidity does get hunted. Now, not ours, but large hedge funds, for example, they might be battling against each other based on the liquidity story. So that story is the following. For example, right here, we see that we have some down movements and we have that swing low. So that liquidity, that's important to understand. because below that swing low right there are sell stops. Again, there are multiple different orders that you have in the market. There are limit orders, there's market execution orders, and there's also stop orders. So stop orders, and I'm going to show you this in the chart, what that would look like in a little bit, but stop orders is essentially where we trade, in this case, below a certain level, and that allows an order to get activated. So in this case, a sell order. Now that's extremely relevant to understand. The reason why is because large hedge funds, they tend to trade very simple strategies. So for example, they might be trending traders. Now, I always like to refer to this book because there's this book that's called The Turtle Traders or something along those lines. And it talks about how they trade with large amounts of capital, and they're essentially trending traders. So when we, for example, reach below a low, what these trending traders, these hedge funds, the large institutions again expect, because we are trading below a low, that tells us, okay, the market might be weak, so we are likely to keep continuing lower. Now that strategy, there's nothing wrong with that. Again, these hedge funds are trading millions and billions, so making fun of them, that would be silly, because that actually works, and it works very well. Otherwise, they wouldn't be using it. So what often happens is that we see that when we reach below it, we run the liquidity. So this is what we see, a run on liquidity right there, where that works very well. But in some instances, there's also going to be cases like these, where we have similar scenario right here, just bullish, and above that swing high right there are buy stops. So the same exact thing, when we trade above that swing high, then buy orders get activated. So large hedge funds, they might assume, okay, since we trade above a swing high right there, that tells us that the market is strong, so we can keep continuing higher. Again, that works very well when there's a run on liquidity. But when we see something like this, and instead we create this reversal because now there's a sweep of liquidity. Now there's a large difference between this run on liquidity and the sweep of liquidity. And that's that hedge fund story, which again, we're going to dive into and what that looks like on the chart. If you really want to understand the in-depth analysis of a run on liquidity or a sweep of liquidity, you should understand when we run liquidity right there, we are comfortable below the low. And the reason why that matters, again, I'm going to dive into in just a second. Essentially, what you can also say is that we have two stings right there. So we sting below it the first time and then the second time as well. It makes us comfortable below the low. And on the opposite right here, we also, when we have a sweep, we are not comfortable. So what tends to happen is that we have one sting, or at least it's an aggressive move towards the opposite side. Of course, this is all fun, but what does that actually look like in a chart? Now we're looking at the dollar right here, the 4-hour time frame. Again, this happens on every single time frame as well. It's a fractal concept, meaning goes from the 1 minute to also the higher time frame. But understanding the higher time frame to the monthly, we work our way down because that's the stronger time frame. So for example, here on the 4-hour time frame, what happens below this swing low? Again, there's two options. Whenever we trade back below a swing low like this, the first thing we need to figure out is if we are running that liquidity or if we are sweeping it. Because I need you to understand the following, that in trading, what you are essentially doing, you are essentially refining the options to get to a high probability trade ID. What does that exactly mean? Okay, when I open a chart, there might be many different things as to what can happen. For example, we might continue higher, we might continue lower, we might consolidate. When we reach below, so for example, right here, we trade below this swing low, we know there's two things of what can happen. We can either run it to continue lower, or we can sweep it to continue higher. So whenever you open a chart and we are below a swing low and there's not a clear conclusive ID if we are running it, if we are sweeping it, then you are exposed to two different options, two different possibilities of what can happen in the market. Essentially, you need to choose, and then it becomes guesswork. So then it becomes low probability. There's no clarity behind that. So we need to refine the options. We need to take away either the option that we are going to run it, or we need to take away the option that we are going to sweep it, which is through the following. So again, when we reach below a swing low, there's going to be sell stops below that low. Now to imagine that, picture something like this right here. So these hedge funds right there, since we are trading below the low, that sell stop gets activated right there. They might target somewhere lower right there. and the stop loss goes above a recent swing high. It's also important to understand. So what happens right here is because we trade back below a low, they expect the market is weak right here, so it's likely to keep continuing lower. And again, a lot of times these strategies, they work very well. And they work even better when you understand what the difference between a run or a sweep of liquidity is. Because what happens at this moment in time? Well, at this moment in time, we see that we have this aggressive move. So we see a very long wick right there. We have an aggressive move to immediately trade back above the original low right there. Why does that happen? Well, on the opposite side, there might be another large institution that actually needs that liquidity right there. Now, the reason why the market runs on liquidity is, again, for every sell order, there needs to be a buy order in the market. For every buy order, there needs to be a sell order. These orders don't just come out of thin air all of a sudden randomly. No, there needs to be an order on the opposite side. Now, we are in Forex, for example, we're working with $1 trillion market. So what that means is that, for example, my order, when we are trading in a live market, which usually if you're trading with prop firms, you're trading even on a demo account, that liquidity is really not that relevant because you can just click buy and sell and there's always going to be another order on the opposite side, if that makes sense. Well, I say always, but most of the time. But when we talk about large hedge funds, when we talk about very large orders, there's not just going to be a large order on the opposite side to match that order. So to match a buy, there's not going to be just a random large sell order on the opposite side. So that liquidity needs to be generated. So for example, where are those large orders interested, in this case, to sell? Well, for example, below that low, because that's the way they trade. That's the way they operate. So when this sell order right there gets placed, well, there also needs to be a buy order, of course. And that buy order is sitting right there, where a large institution might be on the opposing end looking to buy. So then they get matched. And when they get matched and there's, for example, a stronger buy order right there, so there's more intent to go higher right there, then what happens is that we will see a sweep of liquidity right here, where this order, the order right here, gets tricked into the market and their liquidity gets used for both, not only the entry right there, but also for the take profit. Because again, think about it. When the winning hedge fund, in this case right here, is placing this buy order, they also need, again, it's a large order, so they need liquidity at the top right there, at their take profit. That take profit is a sell. Someone else on the other side needs to buy. What does a short, a sell order right there do? Their stop loss is a buy order because you're buying back at a loss. So the reason why this aggressive move right here happens is because this order, the trapped trader, let's call it like that, needs to be suffocated. And what I mean by that is, what I mean with suffocated, it needs to be suffocated, is because you can't allow this order to get back to this low right here. Why? Because when we get back to this low, that right there, they now have a potential opportunity to take off the trade. So to mitigate the order at, for example, a break even, etc., not at a loss. So when this order is taken away, this order, the winning trader right there, doesn't have the opportunity to then take off the order at that take profit right there, where the stop loss of the losing trader was. So the losing trader's order needs to be suffocated right there to move fast towards the opposing side in order for the winning trader to also exit that position at a take profit. So they can use the stop loss liquidity as their take profit liquidity. Now that leads to the following story. And when you understand that story, it becomes a lot easier to spot. For example, this right here is a sweep. And a sweep happens aggressively because of the reason and the story we just mentioned. And in other words, we are not comfortable below that low. But on the opposite side, again, imagine an order right here above that high. When we reach that high right there, if we are going to sweep it, again, we are going to use this liquidity to move fast towards the opposing side. For example, that swing low right there. Now, what we see instead is that when we reach above this high using that same method, we see the first thing above it right here. And the second thing simply continues higher. So if we go in a little bit of a lower time frame, we see that we have the first thing above it. At that moment in time, we're not too sure what's going to happen. We can run it, we can sweep it. What are we going to do? But then when we sting back above it again, above the original high right there, we can confidently say that we are now comfortable above the high. So if we imagine the hedge funds right there that placed a buy stop above that high right there, they are allowed to go break even. They are allowed to mitigate their position. So there's no need to sweep that liquidity. There's no opposite order at that moment in time. So this right here is a run on liquidity where we are comfortable above the high based on that story. Now then what we will see is when we run the liquidity, we are allowed to continue higher towards a next target. So in other words, this sweep right here, this becomes a reversal. This run right there, that becomes a continuation. And you'll see this happens quite often. So for example, with this swing high right there, we actually sweep it, aggressively move towards the opposing side because we need that liquidity. And then once we reach these lows right here, we run the liquidity. That means we can continue lower towards lower targets. And that eventually allows us to understand that we reach this large low right there. And that low right there, once we reach that, again, we need to understand, are we running that low? Are we sweeping that low? Which at this moment in time, you could argue that we might be looking at a sweep right there to potentially continue higher, unless we now start to trade back lower and climb back below the original low, so become comfortable below that low. That is the real liquidity story. And again, understanding that story, so take your time to understand it, maybe watch it a couple of times, do your own case studies, because understanding that story, that is the most important part. Now, for example, also allows us to understand why two-candle rejection happens the way it does. So for example, two-candle rejection again is what we talked about in the previous episode, where we have any PDRA, when we sting back into that and we have the first respect candle, so a long wick at the bottom right there, we understand the next candle can continue higher. But there's also another scenario where we have another PDRA, let's say it's a fair value gap right there. The first candle is not the rejection, so not that long wick, it's instead that big body. Then we see the previous candle low right there gets swept to then continue higher instead. And then that in turn allows us to understand what we talked about in the previous episode as well. When you have that target and you are working with order flow, or you have resistance, for example, in the form of this fair value gap, when you have the rejection high from the two candle rejection right there, which is either going to be the first candle or the second candle. If we run the rejection high right there, that tells us what the next target is likely going to be. So right here, that previous candle high right there, the rejection high, that eventually gets ran right there. And when we run the rejection high, we can continue higher towards the target. So we can confidently say what we are moving towards next, which PDRA is next. Now this then again leads to the same story of refining those different options that we have. So for example, right here, we have this bullish fair value area, which is something we're going to dive into in the next episode, what that is. That fair value area is what we can potentially continue higher from. We see two candle rejection right there is still intact. So we have this rejection low. So if we want to continue lower, we need to essentially take away all the different options, all the different possibilities, the arguments as to why we might want to continue higher instead. So right here, for example, when two candle rejection is still being respected and we still respect the fair value area, the bullish one, that gives us an argument, a reason as to why we might still be bullish. But when we disrespect this fair value area, then run this low right there, that gives us only bearish options, because now we have taken away the bullish option right there. But that is if we run this low. So in the recent price action we see right here, this is going to be very interesting. It's something to pay attention to. I have no idea how this will play out. But based on the rules that we have, we can get a certain ID. We can set ourselves parameters. So if X happens, we expect Y. For example, we have this fair value area right there that we can continue higher from. This right here is the rejection low that we have. What that means is that rejection low right there, if we want to disrespect the fair value area, we should run it. So we should see us getting comfortable below it low, create new bearish fair value gaps right there to continue lower. But in the meantime, at this moment in time, we are still respecting the bullish fair value area. So we can still sweep this low to continue higher. But on the opposite side, we also have this bearish fair value gap right there. So we can potentially continue lower from the bearish fair value gap, but we can also potentially continue higher from the bullish fair value gap. It's a bit uncertain. Now, either we run this high or we run this low. And if we run the high right there, we can confidently say we might be continuing higher. Because then at that moment in time, we have disrespected this bearish fair value gap. But if we run this low right there, then we can calmly say, well, we might be continuing lower, because then we have disrespected the bullish fair value area right there. Now, once we, for example, create a daily fair value gap right there, and we would do the same exact thing with the 2 candle rejection, understanding if we are sweeping or running, and that gives us a very powerful understanding of what we want to do with this low that we are seeing. Are we sweeping or are we running that low? And then based on that understanding, then eventually understand if we want to continue lower right there or if we want to continue higher in a very objective manner, which gives us certain control of our trading. This is why I would highly advise either go back to watch episode 2 right there or move on to watch episode 4 right here on your screen or in the description as well. All right, perfect. Thank you.